The number one question I get when I'm talking to real estate agents or mortgage loan originators, well, for real estate agents, the number one question is, can we list your REO? But after that, so you're supposed to laugh at that. I know you're eating, but after that, the biggest question I get is, when are we getting back to normal? When are we getting back to, you remember normal. It was about 4 years ago, and people were buying lots of real estate, and we didn't need a down payment, and we didn't need good credit or even a job, and we could get a loan. And I didn't need to worry about convincing people that real estate was a good investment. It just, they came to me in droves, and I really didn't want those quirky buyers. Just give me listings. Remember that time? When are we getting back to normal? Don't wait. Larry Kendall was talking this morning, for those of you that had a chance to hear him, and I thought his message was a good one about not waiting for things to change and get back to normal. And get back to normal means a lot of things. So what I want to do today is walk you through several things. One, from a mortgage lending and banking perspective. That didn't used to be as interesting to you or as important to your business. Pretty much, I sell the house, send them to somebody that's going to originate the loan, it's going to close, and we're off. How much more important are you feeling it is today? It's paramount. So I want to give you some color and context on what's going on in the mortgage space, because now more than ever, those of you that are selling real estate need to understand that to manage your businesses. I do want to talk briefly about where we see the economy headed. I want to be careful not to contradict Dr. Yoon ahead of his presentation. Hopefully you're not more optimistic than me. But I do want to make sure that, I was talking earlier with Tom Kolinsky, and he said, you're going to tell us all really good things, right? I could, but I think that wouldn't be doing justice to you in how you plan for 2011. And so we'll talk a little bit about what some of the dynamics are of 2011. And then I want to also cover the regulatory changes that are going on. They have significant impact. The federal government is now having far more impact on how you sell homes and the amount of home sales you can do than ever before, and it's important to adapt. And then finally, we'll take a little bit of a look forward and see what that looks like. So let's talk about normal. I brought a slide, and don't worry about reading it. The left-hand column are the top 25 lenders in America in 2006. If it's red, they no longer exist. If you thought 2006 was normal, it's not. 2008 top lenders are the middle column. If it's in red, they're gone. And then in the right column are currently the top lenders, mortgage lenders in America. Wells Fargo is at the top with about 25% share of the market. We never thought we'd see any single lender do 1 in 4 mortgages in America, but in fact that is happening today. Bank of America is second with about 20%, and then it falls off a cliff. Chase is at 8, Citi is at 4, GMAC is at 2, and anybody below them is 1% or lower market share. So it's a different world than we lived in 4 short years ago, and the landscape is amazingly different. I was originating mortgages here I started in September of 1983. Barry, you and I did a lot of business together. He looked different, but we all do. We all do. But a lot of your business cards, I noticed, look the same. So, but we did quite a bit of, I took my first loan application September of 1983. My friend Dave Stevens, who who Dwayne mentioned, was also originating. He took his first loan application in September of 1983. We both worked for a company called World Savings. You may remember them. I was in Boulder, he was in Denver, and we closed our first loans the next month. Mine was for $80,000. I remember the application. It was well and septic and meets and bounds, and I didn't know what any of that stuff was. What's a coliform? I have no idea. So I closed it. It was $80,000. Dave closed one loan. It was for $88,000. Really ticked me off. Last time he ever beat me. He did call before. He's now commissioner of FHA, for those of you that don't know. He did call me right before we came in here and apologized for not making it. He was asked to be at a congressional subcommittee testimony about the mortgage crisis, and it is fairly significant today, as you know. A lot going on, a lot of concern in Washington about the foreclosure crisis, a lot of concern about the strength of the mortgage market and about what's going on there. So he would really rather be here. His son goes to school here. He'd rather come, but he sends his apologies. So anyway, back to then. Also in December 1983, I was working here in Boulder in a place that's now called the Boulder Cafe. For those of you that eat the good little fondue, they got great cheese fondue. So order the cheese fondue. But back where that's made, I sat and took loans. And in December of 1983, I took my very first stated income mortgage ever done in Boulder. And let me just explain the difference between a stated income loan in 1983 and one today. It required 25% down. It would allowed no secondary financing and required a perfect payment history. And if you had all three of those, you could get a stated income loan. And we could go through the underwriting theory if you want to, but you can see how that's a very safe loan. And it's a responsible loan. Roll back to 2006, and stated income loans were the norm. And one of the things I get asked is, when are we getting back to normal? Is when are stated income loans coming back? Because I've got all these people that can't get a mortgage and can't buy a house if we don't have stated income mortgages. Think about the way they were done 4 years ago. They were nothing down, any kind of credit, and we didn't really care what you did for a job. You just, as long as you told me you made enough, it's okay. Those don't exist anymore. And by the way, the federal legislation that passed, the Dodd-Frank, now known as Dodd-Frank Financial Reform, prohibits lenders from making a mortgage in which they do not understand a borrower's ability to repay the mortgage. So even going back to the way it was done in 1983 is off the table for the foreseeable future. So don't wait. Second is that, we'll just go back, we'll get rid of the distraction over there. Second is that you're probably noticing in the mortgage world that you have to give every piece of documentation in a borrower's house in order to get qualified for a loan, right? So when you go take a loan application, send me every document in your house, everyone, the Safeway receipt, everyone, the King Soopers receipt, everyone, bring them all. We will, ask for that, we'll put it in the file, and then maybe 5 days before closing, we'll ask you for some more, right? Because surely you've accumulated more paperwork since when you applied. So I'm being a little sarcastic, but what is happening here? In the new normal, we also have a situation where mortgage lenders, probably the biggest issue hanging over mortgage lenders' heads today is that if a loan is defective at all, they need to repurchase it, put it back on their balance sheet. Remember the way mortgage, it's not the way it was done with the old savings and loan industry. We originate a loan, we keep it on our balance sheet till you pay it off. Virtually all mortgages originated today, a lender originates the loan and then sells it into the secondary market. And today, Fannie Mae, Freddie Mac, or FHA are your primary conduits, package them into securities, and then you probably all have them in your retirement accounts in some way or another, mortgage-backed securities. If those loans start to go bad and Fannie or Freddie looks at it and finds it to be defective in any way, and by the way, they're very aggressive in what defective means. Might be a T wasn't crossed. But if it's defective, it's getting pushed back to the lender. And the lender is then required to buy it back and take any losses that occur as a result of that. That's having significant impact on how you have to prepare your clients for mortgages today, because no lender wants to originate a mortgage with defect. And the primary defects that happen are usually in the calculation of a borrower's income. And if they are salaried, been in the same job for the last 5 years and have not had a lot of income change, that's not a big deal. But you probably don't run into a lot of those customers. You know, they might have limited partnership income. They might have some self-employed income. They might be commissioned or something else with fluctuating income. They might have just started a new job. All of those things are requiring lenders to ask more and more and more questions about how we calculate their income. And we've seen hundreds, and I'm not exaggerating, hundreds of underwriting guideline changes come through from Fannie and Freddie over the course of the last, each year, hundreds each year for the course of the last 4 years. And so it's even difficult for mortgage lenders to keep up with what the current guidelines are in this respect. So this is why part of the new normal, part of the new way we do business today is first for you to make sure that you're paired with a mortgage lender that you know and trust and has strength behind them to persist for the long haul. The last thing you want to do is get to 3 days before closing and find out they went out of business or their source of funding dried up. But the other thing that I'll suggest is when you're working with a client that needs to take a loan application, don't let them do it by phone or over the internet. Make them meet face-to-face. Make them meet face-to-face with the lender, the loan officer, because so much better communication happens that way. I can show you my documentation and have you tell me that, yes, that's what I need, or no, that's not exactly what I need. If we're doing this by phone and I'm mailing it in, that causes delays, and here's what happens. It's human nature. Loan officer looks at it and goes, oh, they didn't send me what I needed. You know what? I'm going to put it in the file, see if the underwriter will take it anyway. How do you think that's working today? So have them meet face-to-face and get everything they need up front. And I don't even need to tell you about pre-approving them, getting them pre-approved before you even go house hunting. So that needs to be part of what you do, but there's so much more effort up front that needs to be done on the mortgage on that side.